All right, we mentioned the stocks in North America did open higher. I'm not sure how we would describe this market, though, and I want to bring in our friend Adam Johnson, who's the founder and author of the Bullseye Brief, for a deeper dive. AJ, it's always great to have you with us. We just spent basically 30 minutes talking about the Fed, so I don't want to dive too deep into central bank speak, but it feels like, on the one hand, the market feels like, given what happens when you keep raising interest rates, that regardless of what the Fed says, we might be nearing the end of the rate hike cycle, which is one of those things you're typically looking for if you're trying to figure out if a bear market is done. The complicating factor is that because of all these interest rate hikes, there is that longer-term uncertainty on where the economy lands and whether that makes the investing landscape a bit dicey. Where do you weigh in right now as the guy who's generally more optimistic than not?
Yeah, John, I think what all of us need to do is to cut out the noise. There is so much noise in this market. I mean, you just look at some of the actions today. Coinbase down 20%, Square down 20%, because Coinbase got a Wells notice, means the SEC wants to just look into it. Square down 20% because Hindenburg Research says, oh, it's a fraud. Hang on a minute. Let's just take a deep breath. What I think happens at the end of bear markets is that everybody is looking for that next shoe to drop. And you know what? The shoes have already dropped. People keep pulling on strings trying to figure out who's the next bank to go belly up. Well, guess what? They're not going to go belly up. They've been saved. There's a buy-in. This is what happens when markets bottom. And as far as the Fed is concerned, they're done. They told us they're just about done yesterday. They said maybe there's one more, maybe there's one more. And if you look at the Fed forecast, what they say is going to happen with the economy, GDP might come down a little bit, but it won't go negative, meaning no recession. And employment might go up a little bit, but only to 4.2. We've been at a 50-year low. So I think what we all need to do is just take a deep breath and recognize we've been through a lot. There's a lot of noise, there's a lot of mess, but if you're looking for things to get really bad now, after they've already gotten bad, I think you're out of step.
Okay, and I'm glad you mentioned trying to figure out stages of a bear market, because we do need to remind people, at least if we're measuring it through the index of indices, the S&P 500, which ends up being, for better or for worse, the place that everybody looks first and foremost. I mean, that all-time high was January of 2022. So by my math, we're more than 14 months, more than a year and 2 months, maybe almost a year and 3 months, really, at this point, into a bear market. And it probably starts to be worthwhile to look at the average length of bear markets and maybe even look at kind of the circumstances around the economy in all of those cases to try to determine where we're headed from here.
Well, actually, I can make that easy for you, John,
Okay.
and you're absolutely right. Your instincts are right on. What have bear markets looked like in the past? And 14 to 15 months and down about 30 to 35%. Well, that sounds an awful lot like what we've seen in the NASDAQ. The S&P hasn't gone down quite that much, but the NASDAQ has, and that's where the heat has been. So, yes, I think your instincts are right on, John, and I also think that the market is right there. In other words, now is the time to start looking for things to buy. It's hard to do. Buying in the hole is very hard to do, but I think that's what we all need to focus on. It's not to run away and say things could really get bad from here. No, they've already gotten bad. Now's the time we actually put money to work.
And I do want to emphasize tech before we let you go, not because it's the only area you're looking at, but because even at a time when there has been a lot of bearish sentiment, I see a stock like Nvidia, which is up 80% this year, despite all the negative headlines out there, and Meta, which had a just downright lousy last year. And look, they're laying people off. That is very sobering. I don't know what that's going to mean for morale within the company, but the stock is up 66%. You see these names and you think what?
Risk on. Yeah, I think risk on, John. And it's not that I think risk on, it's that the market is telling us risk on. People are looking at names like Meta, like Nvidia, Salesforce.com, Palo Alto, Amazon, Apple. These are all names that we know, companies we can understand. They're all, by the way, best in breed as well, and that's important. But investors, professional investors, are looking at these best in breed, big cap tech companies and saying, hang on a minute, they've fallen too far. It's time to buy. And the fact that some of these names, the ones you just mentioned, Nvidia and Facebook, have, well, yes, they're up this year, but they've actually doubled from their lows, practically doubled. In the case of Nvidia, it already has doubled, and more than doubled in the case of Facebook or Meta. Yeah, that's telling you that this thing has gone too far and that there's value and that people are coming in. So I think that should be a loud and clear message to the rest of us, John, that it's time to start dusting off the playbook. What do we do when bear markets end? And the short answer is we buy best in breed companies.
AJ.